Morning, all of you. So, coming to the next one, IFRS 9, financial instruments. Financial instruments. So, generally, financial instrument is nothing but it is any contract. It is any contract that give rise to financial asset of the one entity, and it will become financial liability or equity instrument to the another entity. So financial instrument is nothing but it is a contract which becomes financial asset to the one entity and financial liability or equity instrument to the another entity. So it become an asset to one person and liability to another person, or liability or equity instrument to the another person. For example, A Limited and B Limited is there, and A Limited sell the goods on credit basis worth 3 lakh to B, worth 3 lakh to B Limited. So in this scenario, the transaction, so sale of the good is said to be a what contract. The transaction become an asset to the one person, liability to the another person. Asset to whom here? Mrs. A Limited. So it will become financial asset to the A Limited. It will become financial liability to the B Limited. Financial liability to the B Limited. So means A Limited is going to receive the amount in future. That benefits are going to receive in terms of the cash or in terms of the kind in future. So that's why it become asset to the A Limited and become liability to the B Limited. It become liability to the B Limited. For example, X Limited sell the debentures to the Y Limited. X Limited sell or issue the debentures to the Y Limited. Issue the debentures to the Y Limited. Means who purchased the debentures here? Y Limited purchased the debenture. Means for Y Limited it will become the investment. For Y Limited it will become the investment, and it is going to receive the cash or asset or any benefits in the future. So it will become the financial asset to the Y Limited. Then to the X Limited it will become what? Financial liability. Okay, so it is a contract, so which give rise to financial asset of one entity and financial liability or equity instrument to the another entity. Financial liability or equity instrument to the another entity. So for example, one more example is, for example, C Limited and D Limited is there. C Limited purchase the shares purchase the equity shares of D Limited. C Limited purchase the equity shares of D Limited. Then the transaction become an investment to the C Limited, and it will become what? Financial asset to the C Limited, and it will become what? Equity instrument or equity. So, or equity liability to the D Limited. Equity liability to the D Limited. So, in this way, the financial instrument is nothing but any contract that give rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Financial liability or equity instrument of another entity, then that contract is said to be a what? Financial instrument. That contract is said to be a what? Financial instrument. So here, these financial instruments, but some cases are there, like for example, physical assets are there. Physical assets like inventory and plant and machinery, PPE, property, plant and equipment. So these are not covered under financial instruments. And even prepaid expenses, those are also not covered under what? Financial instruments. Those are not covered under what? Financial instruments, because PPE itself become an asset to the one entity. It does not create any liability to the another entity. It does not create any liability to the another entity, and the benefits relating to the respected asset will be received in future by the single party. But coming to the inventory or PPE, the transactions incurred in relation to the inventory, like sale of inventory, sale of goods on credit basis, it will become a financial instrument because it create financial asset to the one person and financial liability to the another person. Purchase of goods on credit basis, it will become financial instrument, but physical inventory itself is not a financial instrument. It is not a financial asset at all. So these financial instruments are classified into the two types. One is financial asset and another one is financial liability. So one is what? Financial asset, another one is what? Financial liability. Okay, then here, first of all, what is meant by financial asset? So financial asset is nothing but it includes the asset which includes cash, which includes what? Cash, or a contract or a contractual right to receive cash or any other financial asset, to receive cash or any other financial asset. So financial asset includes what? It includes cash. It includes what? Cash, or a contractual right to receive the cash or any other financial asset, any other financial asset from the another entity, any other financial asset from the another entity, from the another entity. And third one, so a contractual right, a contractual right to exchange, a contractual right to exchange financial asset or liability with another entity with another entity under conditions that are potentially favorable. A contractual right to exchange. So financial asset or liability of another entity under the condition that it will become potentially favorable to that entity. It will become potentially favorable to that entity. And the last one, an equity instrument of another entity. So this is said to be a what? Financial asset. So financial asset includes what? It includes cash. It includes cash or a contractual right to receive the cash or any other financial asset from the another entity. If you observe the previous example, A Limited sell the goods to B Limited, and that is a contract, and that contract become receivable to A Limited in the future because it is going to receive the amount in cash. So that is said to be a financial asset. A contractual right to receive the cash from the another entity, or a contractual right to receive the financial asset from the another entity. Not only in cash. So you may receive that benefits in another financial asset also. And a contractual right to exchange financial asset or liability with another entity under the conditions that are potentially favorable. So this is the best example for options. And the last one is an equity instrument of another end, means investment in equity shares of another company. That will become equity instrument, that will become financial asset to us. For example, we purchase the holding company is there. Holding company purchase the shares, equity shares of subsidiary company. Then that will become financial asset to the holding company. Means an equity instrument of subsidiary company. An equity instrument of what? Subsidiary company. So this is what is meant by financial asset. So example, as we discussed, debtors and debentures of another entity or equity shares of and means investment in debentures or investment in equity shares of another entity, and options, etc. But remember, physical asset is not liable. Physical asset is not covered under financial asset term. Physical asset like inventory, PPE, those are not covered. And some more thing is, so prepaid expenses are also not covered under financial asset. So remember, this chapter is very, very important, and the most important thing is definitions are very important. We may have straight questions. So explain which of the following items are covered under the definition of financial asset. You need to remember these 4 points. So what is meant by financial asset? Okay, so it includes what? Cash and a contractual right to receive the benefits in terms of cash or any other financial asset from the another entity. and a contractual right to exchange the financial asset or financial liability with another entity under the conditions that are potentially favorable, and an equity instrument of another entity, So these are all said to be a what? Financial asset. These are all said to be a what? Financial asset. Then coming to the next one, what is meant by financial liability? What is meant by financial liability? So financial liability is nothing but, so any liability that is a contractual obligation, so to deliver the cash, or to deliver another financial asset, to the another entity, to deliver the cash, or to deliver the another financial asset to the another entity, and or to exchange that contractual obligation created to exchange financial asset or financial liability with another entity, financial asset or financial liability with another entity under conditions that are potentially unfavorable or unfavorable, or, and the last one is that will be, settled, in entities equity instrument. In entities equity instrument, and the meaning is, so the last one, for example, A limited and B limited is there, and A limited issue the debentures to B limited, and these debentures are nothing but what? Convertible debentures. These debentures are nothing but what? Convertible debentures, and as per the agreement, that conversion to be happened after 5 years. Then at the time of issue, this will become financial liability to the A limited and financial asset to the B limited. So in this case, coming to here, at the end of the 5th year, how these debentures are going to settle? So if the party agreed for the conversion, then company will pay the cash to that party. If the party agree for the conversion, then company will issue its equity shares to that party. For example, out of the total 1 lakh debenture holders are there, and around 80,000 debenture holders are agreed for the conversion. Then agreed for conversion means what? They agreed to receive the equity shares of A limited instead of receiving the cash. Generally, at the end of the redemption period, or at the end of the life of the debenture, the company required to settle the debenture holder in terms of the cash, right? in terms of the cash. So here company give the option to that party, so they may convert their debentures into the equity shares or they may receive the cash. That complete option is in the hands of the debenture holder. So if the debenture holder agreed to take the equity shares of the company, then this financial liability is settled by issue of equity shares of A Limited. If the debenture holders are not agree with conversion of the debentures into equity share, then company required to pay what? The financial liability in terms of what? Cash. In terms of what? Cash. So that was he clearly stated. That was he clearly stated. So the financial liability is a contractual obligation which create which contractual obligation which results in delivery of cash to the another entity, or delivery of another financial entity to financial asset to the another entity. Delivery of financial asset to the another entity. For example, we purchase the goods on credit basis. We purchase the goods on credit basis from the Mr. A. He become the creditor. That will become financial liability to us and financial asset to the Mr. A. Financial asset to the Mr. A. So we need to pay the cash to the respected party after some period. But here, so we provide the asset or we provide the equity shares of the company, or we provide the debentures of the company to that party, or we transfer the equity shares, or we transfer some investment to the respected party. And instead of paying the cash, or instead of settling the creditor in cash, we issue what? Equity instrument or a debenture instrument. So the delivery to deliver the cash to the another entity, or delivery made in terms of financial asset to the another entity, or to exchange the financial asset or liability with another entity under the condition that are potentially unfavorable. And the last one is that will be settled in entity's own equity instrument. So the best example is in case of conversion. I hope you guys clear. Okay na? So please respond.
Yes, sir.
Any doubts, Amma? The best example for okay, Amma. The best example for financial liability is nothing but what? Creditors. The best example for financial liability is nothing but what? Creditor or debentures. So remember, debentures of another entity will be the financial asset. Debentures of own company is the financial liability. Debentures or debentures, and one more thing is redeemable preference shares. Redeemable preference shares of the company. Redeemable preference shares of the company. So these are called as financial liabilities of the entity. So that contract which create financial asset to the one person and financial liability to the another person, that is called as what? Financial instrument. And those are generally classified into the two types. One is financial asset and financial liability. So in this chapter we are going to discuss these two topics. Financial asset. So financial asset and financial liability. Okay, financial asset and financial liability. And so here we have the three standards. One is IFRS 9 financial instruments, and IAS 32 So presentation of financial instruments means, so in this standard we will define, means the classification of the financial instruments are defined under this standard and how they are presented in the financial statement. And the next one is IFRS 7. This is relating to the disclosure of financial instruments. So these three we covered in this chapter. Okay. Then first we will discuss financial asset. So financial asset. So in case of financial asset, there may be a equity instrument, or there may be a debt instrument, right? There may be a what? Equity instrument, there may be a debt instrument. So equity instrument is a nothing but investment in equity shares of another entity. Correct? Equity instrument is nothing but what? Investment in equity shares of another entity, or investment in debentures of another entity. This is the best example for debt instrument. Then first we discuss what equity instrument. So generally equity shares of another company are purchased for two purposes. Two purposes. Those are purchased for trading purpose. I hope you guys know about the trading of the shares. So we may purchase that equity instrument for what purpose? Trading purpose. Or we may purchase it for holding purpose. Can anyone tell me which is meant for short run purpose, which is meant for long run purpose here? So equity instruments are generally purchased by any person, are generally purchased by any entity only if any one of these purposes. For one is for trading purpose, another one is for holding purpose. So if it is meant for trading purpose, means whether it is meant for short run purpose or whether it is meant for long run purpose. Sorry, short run purpose. So it is if it is purchased for short run purpose, if it is purchased for trading purpose, means this is meant for short term purpose, and this is purchased for long term purpose. And in this case, as per IFRS, we call it as a default alternative. Default alternative means purchase of equity shares or investment in equity shares for what purpose? Trading purpose. Investment in equity shares of another entity for trading purpose is covered under default alternative. Default approach. Default approach. And holding purpose or long term purpose is called as what? Alternative approach. Alternative approach. Holding means if the shares are purchased by the party for long run purpose, that is covered under alternative approach. And everyone please remember these words. So default approach and alternative approach. And remember one thing, default approach means if the shares acquired by the party for trading purpose, and alternative approach means it covers shares acquired for, means equity shares of another entity acquired for holding purpose. Equity shares acquired for holding purpose. And this approach is called as fair value through profit and loss. So why we call this one as a fair value through profit and loss, I will explain. And this approach is called as what? Fair value through other comprehensive income. Fair value through other comprehensive income. So whenever in case of any problem, if you see the word like a default approach, then we routed that element or we routed that investment as fair value through profit and loss. And if you have this one alternative approach in the problem, we have to account it as fair value through other comprehensive income. Fair value through other comprehensive income. So is it clear, everyone? Say yes or no.
Yes, sir.
Then anyone tell me the revaluation procedure as per IAS 16? Revaluation procedure as per IAS 16. Then in case of as per IAS, what is meant by IAS 16? PPE, property, plant and equipment, right? So as per PPE, in case of increase in value of an asset, transfer to which account?
Revaluation surplus.
Revaluation surplus, right? And what about the another aspect? There are two aspects are there in the transaction, right?
Yes, sir.
Initially at the time of revaluation, in the year of creating the revaluation surplus, we need to disclose it in the profit and loss through the another account, if you remember. Which account? Have you understood my question? But please respond. Yeah, other comprehensive income. And one more thing is, so do you remember IAS 40? What is meant by IAS 40?
Investment property.
Investment property. In case of investment property, what is the treatment for revaluation?
Gain or loss transfer to P&L account.
Gain or loss transferred to P&L. I hope you guys clear about the accounting relating to those elements, right? So here, in case of short term or fair value through the profit and loss, fair value through the profit and loss means equity shares of another company purchased by the entity for trading purpose. Purchased by the entity for trading purpose. In this case, any gain or loss relating to the respected fair value adjustment is transferred to which account? Profit and loss account. Is transferred to which account? Profit and loss account. But in case of if the equity shares of another entity acquired for long run purpose or holding purpose, then we follow the fair value through OCI, other comprehensive income. In this case, that increase in the value of an asset, when we compare the fair value at the end of the year, that increase in the value of an asset is transferred to which account? Other comprehensive income, and in balance sheet we have to show under investment reserve. There we show under revaluation surplus. If you remember, in this case we have to show under what? Investment reserve. Investment reserve. I will explain. So two elements are there relating to the financial assets. Relating to the financial assets. So the first approach is default approach, and another one is what? Alternative approach, right? I hope everyone follow me. So default approach and alternative approach, and this is called as what? Fair value through profit and loss, and this is called as what? Fair value through other comprehensive income. Fair value through other comprehensive income. Clear, everyone?
Yes, sir.
Then, so coming to the initial recognition. And I hope you guys clear about the recognition procedure. How to recognize the asset? When it satisfies the definition criteria relating to the asset, we classify it under the respected asset, like PPE, like inventory. Same way we follow for the financial asset also. So generally, in case of initial recognition, so asset is always recorded at, financial asset is recorded at what? Fair value. Financial asset is recorded at what? Fair value. And fair value through other comprehensive income, in this case also we recorded at what? Fair value. We recorded it what? Fair value. And another one is, in case of at the time of initial recognition, the question is whether transaction cost is included or not included. Transaction cost is included or not included. So transaction, what is meant by transaction cost, sir? So then tell me one thing, shall we purchase the equity shares of another company directly from the company or through the broker?
Through the broker.
Through the broker, right? And it means we need to pay what? Some commission to that party. Correct? So for on purchase or sale of, generally some brokerage, broking companies, broking firms are there. Okay, so we always purchase these shares so through the respected company. Then on purchase and sale transaction, they collect some percentage of commission. That is called as what? Transaction cost. That is called as what? Transaction cost. So this transaction cost is always expensed. Is always expensed in case of default approach and transferred to profit and loss, and transferred to profit and loss. But coming to the alternative approach, the transaction cost is capitalized and added to the cost of investment. Added to the cost of investment. Clear? Transaction cost means cost incurred at the time of purchase or sale of the respected financial asset is said to be a transaction cost. The question is whether transaction cost is included in the initial cost of the financial asset or not. So that is depends upon whether it covered under default approach or alternative approach. In case of default approach, the transaction cost is expensed and is transferred to profit and loss statement. But in case of alternative approach, the transaction cost is capitalized. The transaction cost is capitalized and is added to cost of the investment. And is added to cost of the investment. Clear? And another one is fair value gain or loss. Fair value gain or loss means this is relating to what? Subsequent recognition. This is relating to our subsequent recognition. Remember, in case of financial asset, at the end of the every year, we need to test, we need to calculate the fair value of the asset, and we compare the carrying amount of the asset with the fair value. Any change is treated as either gain or loss. That is called as what? Fair value gain or loss, and simply call it as unrealized gain or loss. Unrealized gain or loss. And then what is the adjustment relating to the fair value gain or loss in case of default approach, in case of alternative approach? So please listen carefully, and very important. So fair value gain or loss relating to the default approach is transferred to which account? Statement of profit and loss. Statement of profit and loss. And in case of alternative approach, that is transferred to other. That is transferred to what? Other comprehensive income. Is it clear, everyone?
Yes, sir. Yes, sir.
Then, and one more thing is income. That is nothing but what? Dividend. So because in case of equity instrument, that corresponding company may provide the dividend, right? Then when the dividend received, that is always transferred to statement of profit and loss, other income. Here also we transfer to statement of profit and loss, and to which account? Other income. Which account? Other income. Clear? And for example, disposal or sale of asset. In case of disposal or sale of asset, there may be a chance of creating either profit or loss on sale, right? That profit or loss on sale of that financial asset. That's already, you know, the concept of investment. If the investment sold by the party for either for profit or for loss, the profit or loss on sale of investment is a transfer to which account? Statement of profit and loss. Here also we transferred to statement of profit and loss. Here also we transferred to statement of profit and loss. So if you observe these things, the only the difference thing is so transaction cost and fair value adjustment. Transaction cost and fair value adjustment. Transaction cost here not considered in case of fair value through the profit and loss. Transaction cost is not considered in initial cost of the investment, but here considered or added to the cost of that investment. Added to the cost of that investment. Is it clear? So this is about what? Accounting treatment. So this is what? Accounting treatment. Okay now.
Yes, sir.
For example, so A Limited purchased 10,000 shares of B Limited for $2.5 per share. Clear? $2.5 per share. Transaction cost is transaction cost is $3,000, and these are purchased on for example 1/4/2000 X1. On 31st March 2000 X2, fair value of shares of B Limited is $4 per share. $4 per share. Then, so what is the treatment? So if it is follow the default approach, and if it follows alternative approach. So remember, default approach and alternative approach depends upon the purpose of holding. Purpose of holding by the investor. Means if the A Limited purchase the respected shares for trading purpose, covered under default approach. If the A Limited purchase the shares for holding purpose or long run purpose, that is covered under alternative approach. Alternative approach. Then here we need to calculate fair value gain or loss sum. Fair value gain or loss. Then first, what is the initial cost here? In case of default approach, so remember we need to add purchase cost plus in case of default approach we have to consider purchase cost only. Transaction cost is considered or not considered in default approach?
Not considered.
Not considered. We have to transfer that amount to which account?
Profit and loss.
Profit and loss. Transaction cost is considered in which approach?
Alternative.
Alternative approach. So very good, Amma. And some MCQs are given, like for example, which of the following is covered under default approach? Which of the following is covered under default approach? Like, so some options are provided, like fair value through other comprehensive income, fair value through profit and loss, and amortization cost, so etc. So these type of options are there. So remember, whenever we have the default approach, we have to select which option? Please respond. If you have the default approach, then we have to select which option? Default approach indicate what? Sorry? Default approach indicate what? Please respond.
Trading purpose.
Trading purpose means what is the name? Fair value through profit and loss. Remember that words. Default approach is followed when in case of fair value through profit and loss. Alternative approach followed in case of fair value through other comprehensive income. Clear?
Yes,
Yes, sir.
Yeah. So here initial cost. So how many shares are there total? 10,000 into 2.5. Then tell me the amount.
25,000.
So 25,000. Shall we add the transaction cost or not?
No, sir.
No. So we have to show the investment at this 25,000. So on 31st March 2000 X2, what is the fair value? 4. Then so on 31st March 2000 X2, the asset should be shown at 10,000 into 4. How much? 40,000 is there. So fair value gain or fair value loss?
fair value gain.
So fair value gain. So how much amount of gain is there? 15 50,000. This fair value gain is transferred to which account in default approach?
Profit and loss.
So statement of profit and loss. Okay now. Then in case of alternative approach, so initial cost. So how much? 10,000 into 2.5. How much? 25,000. What is the difference between default approach and alternative approach? One of the difference is nothing but what, Amma? Transaction cost. In case of alternative approach, transaction cost is added or ignored?
Added.
So transaction cost. So how much amount? 3,000. So what is the value? 25,000. Next. On 31st March 2000 X2, what is the fair value? On 31st March 2000 X2, $4 per share. So 10,000 into 4. How much amount is there? 40,000. Then is there fair value gain or fair value loss? Fair value gain or fair value loss? So fair value gain. So how much amount is there? 12,000. And here this fair value gain is transferred to which account? Other comprehensive income in P&L. Other comprehensive income in P&L. Then, and one more thing I will explain here. Presentation in P&L. So presentation in P&L relating to these item on 31st March 2000 X2 means in the two cases. So if you follow the default approach, and if you are under default approach, if you are under alternative approach, if you are under alternative approach, okay. So here in case of a default approach, so transaction cost. So how much amount is there? Transaction cost is shown under what? Other expenses. Transaction cost is shown under what? Other expenses. And the next one is fair value gain is there. Fair value gain is also transferred to statement of profit and loss, right? 15,000. 15,000. Then so total 12,000 is the net proceeds. And here, so presentation in P&L. So here, shall we transfer the transaction cost to the P&L or not here? In case of alternative approach, shall we show it under P&L or not? No, because we already added to cost of the investment, right? So nothing was considered. Then other comprehensive income. In this case, we have to show what? Fair value gain. How much amount is there? 12,000. How much? What is the net impact? 12,000. Okay now. I hope you guys clear about the two methods. 1 minute, Amma. So you guys clear about the two methods, Amma. Note chesara? Amma, note chesara?
Yes, sir.
Everyone, please respond.
Yes, sir.
No problem, Amma. After completion of the class, I will share the notes also. This PDF I will share, okay? So, any doubts till now?
No, sir.
And everyone please respond. Any doubts?
No, sir.
Yeah. Then so here are the questions. So what is the default classification of an equity investment? What is the default classification of equity investment?
Fair value through profit or loss.
Fair value through profit or loss amma. And this is covered under alternative classification. And amortization cost is there, but amortization cost is not applied for equity instrument. This is applied for debt investment. This is applied for what? Debt investment. Next. So ABC purchased 10,000 shares of 10,000 shares on 1st September 2000 X4, making the election to use the alternative treatment. Then tell me, what is meant by alternative treatment?
Fair value through other comprehensive income.
Fair value through other comprehensive income. Under IFRS 9 financial instrument, the shares cost $3.5 each. Transaction cost associated with the purchases were 500. At 31st December 2000 X4, the shares are trading at $4.5 each. So we need to calculate what? Gain or loss. What is the gain to be recognized on these shares for the year ended 31st December 2000 X4? Then first of all, to calculate the gain, what is the initial cost? So total how many shares are there here? 10,000 into what is the initial price? 3.5. Total 35,000. Then transaction cost is added or ignored?
Added.
Added, because we follow the which approach? Here we are under which approach?
Alternative approach.
What is meant by alternative approach?
Fair value through other comprehensive.
Yeah. So transaction cost is how much? 5,000. What is the total? 40,000. Then on 31st December 2000 X4, fair value of the shares 10,000 into what is the fair value on the 31st December 2000 X4? 4.5, right?
Transaction cost to 500.
500 of 5,000. Sorry, 500, right? So how much? 35,500. Okay, Namma? Very good. 35,500. Here, 10,000 into what is the price here? 4.5.
45,000.
45,000. Then fair value gain or fair value loss?
Gain.
What is the gain here?
9,500.
So 9,500. Okay, Namma. Okay, na.
Yes, sir. Yes, sir.
Then so 92. DEF purchased 15,000 shares in KMH company on 1st August 2006 at a cost of $6.5 each. Transaction cost on purchases amounted to 1,500. At the year end 30th September 2006, these shares are now worth $7.75 each. Then we need to select the correct gain and the place it will be recorded. So here two approaches are provided, right? Other comprehensive income and statement of profit and loss. Then first we do it other comprehensive income. Other comprehensive income means what? Default approach or alternative approach?
Alternative.
Alternative approach. In case of alternative approach, transaction cost is added or not considered?
Added.
Added. Then what is the initial cost here? How many shares are there total?
15,000.
15,000 into what is the initial cost?
6.50.
So then tell me 15,000 into 6.5. Fast ga. 97,000. Then we add what? Transaction cost also, right? What is the transaction cost here? 1,500. Then what is the amount? 99 or 90? 99 ega?
Sir.
99. Then on 30th September, so what is the fair value? $7.75 each. 7.75 into 15,000.
16,000.
1,16,250. Then fair value gain or fair value loss?
Gains.
How much?
17,000.
17,250. ఇంకా ఆటోమేటిక్ అదర్ అదే కదమ్మా, స్టేట్మెంట్ ఆఫ్ ప్రాఫిట్ అండ్ లాసేగా. బట్ క్యాలిక్యులేట్ హియర్. సో profit and loss sum, fair value through P&L. Then what is the initial cost? So 97,500. Shall we consider transaction cost here or not? No. Then what is the fair value on 30th September?
160.
So 116,250. What is the gain? Then this is the amount. Okay now. I hope you guys are clear about the financial asset equity instrument. Any doubts in equity investment?
No, sir.
Okay, then so exercise one small problem. So just note it down. So A Limited's draft statement of financial position as at 31st March 2021 shows financial assets at fair value through profit and loss with a carrying amount of 12.5 million dollar asset one for 2020. These financial assets are held in a fund whose value changes directly in proportionate to specified market index. At 1st April 2020, the relevant index was 1200, and as at 31st March 2021, it was 1296. What is the amount of gain or loss should be recognized at 31st March 2021? So actually we have this problem in previous exam papers, and remaining all are straight question. So small difference is there in the problem. Please note it down. I will explain. Anyone can tell me the gain or loss? Anyone? Am I audible or not?
Audible.
Yeah. Noted, huh?
Yes, sir.
So here he has the financial asset which are routed through the financial asset through P&L, whose carrying amount is $12.5 million as at 1/4/2020. Okay, on 1/4/2020, carrying amount is equal to, so $12.5 million when the market index is 1200. So why we consider market index, sir? Because he clearly stated, and the financial assets vary directly in proportionate to the specified market index. Correct? Then on 31st March 2021, what is the fair value? We don't know, but we know the market index 1296. You know the market index 1296. For 1200, what is the carrying amount? 12.5. Then for 1296, what is the carrying amount? Shall we calculate? Tell me. Is it possible or not? So 1296 into 12.5 by 1200. Correct? How much? 13.49. Say 13.5. Okay, now. Then, is it a gain or loss to the entity? Gain. What is the fair value gain? $1 million, right? What is the fair value gain? 13.5 minus 12.5. Equal to how much? $1 million. Then, tell me, this $1 million transfer to other comprehensive income or statement of profit and loss?
Profit or loss.
Statement of profit and, because he clearly follow the financial fair value through statement of profit and loss kada. Is okay namma everyone?
Yes, sir.